Chris here from the Ronin Society. We're going to talk to you about how to read your income statement as a business owner. So this is for business owners that either do their own books or get their books reported to them by a CPA once a month, or if you have a bookkeeping service that books transactions for you and just has you approve payroll. I'm going to teach you how to read your income statement as a business owner so that you can pull some insights out of it, more than just here's what happened, here's how much money we made or didn't make. In part one, we're going to cover business efficiency as a concept. We're going to cover benchmarking, and we're going to cover how to get to the bottom line. So let's start with business efficiency. Your income statement, also known as your P&L or your profit and loss statement, is a summary of all the sales and expenses that you've incurred during a particular period of time. It's generally used to figure out how efficient your business is at providing the goods or services that it sells. What do I mean by efficient? Just like people, some businesses are more efficient at certain tasks than others. Think of a business as the sum of all the tasks that are required in order for that business to operate. Someone needs to sweep the floors, someone needs to call on customers, someone needs to make sure the website is up and running, someone needs to make sure that intake forms are working, etc., etc. In a small business, there are probably hundreds of tasks that need to be completed every day, week, month, and in a large enterprise, there are millions. The efficiency of tasks isn't just relegated to finite things that you can list off and measure with how much time was spent. It's kind of weird if you think about it, but the efficiency paradigm can be applied to things like how efficient is your business at creating a premium brand. For example, if you're really efficient at creating a premium brand, then you don't have to spend a whole lot on sales and marketing, but your business is able to charge more for the same good or service that somebody else also provides. This is often referred to as pricing power. Now, the results of all of these tasks, both finite and abstract, and how efficient your business is at providing them, all ends up affecting your income statement. Now, before we dive into what that looks like, I want to talk about benchmarking for a second. Whenever anyone tells you that something is efficient or that their business is efficient, the first thing you should always ask is, compared to what? Benchmarking is the process of comparing the performance of one business against other similar businesses. For example, it's not useful to compare the efficiency of a steel mill with the efficiency of a consulting firm. The businesses are too different, and it just wouldn't make sense. It would make more sense to compare a consulting firm against other similar consulting firms and a steel mill against other similar steel mills. Now let's talk about getting to the bottom line. Everybody always talks about what's the bottom line. So the bottom line shows up in your income statement. We're going to talk about how to get there. At the very top of your income statement, you're going to see all the sales that you've generated over a certain period of time. Sometimes this is called sales, sometimes it's called revenue, sometimes it's called net sales or net revenue. Below the revenue line, you're going to see costs or direct costs. A lot of people refer to these as COGS, or cost of goods sold, or cost of service. These are the direct costs associated with providing the goods or services that you promise to people in order to generate that revenue. Below your direct costs, you're going to see a list of expenses. A lot of people refer to these as overhead, but these are just the general expenses associated with running the business, and they're usually considered fixed or slightly less variable in that you're going to incur them regardless of how much sales you do. So, for example, your rent's not going to change whether you do $50,000 in a month or $100,000 in a month. After you take out your direct costs and your expenses from the sales or revenue that you've generated for that period, you're left over with a term called net operating profit. But this isn't your bottom line. This is just the amount of profit that you've generated in the normal course of business by providing your goods or services. After we've come up with your net operating profit, we now have to look at a few other expenses that businesses tend to generate before we can figure out what your bottom line actually is. These other expenses can be bucketed into one of three groups. The first one is non-normal income and non-normal expenses. The second one is interest expense or financing costs. The third one is depreciation. With non-normal income and expenses are usually one-time or non-recurring things that affect our income, affect our cash position, but they aren't things that we normally participate in or we expect not to occur again in the future. They do affect our profitability for the period that we're looking at, but we don't expect them to continue to occur. For example, if your business owned a bunch of land and you decided to sell off some of that land, if you sold it at a profit, it's going to create income for you. If you sold it at a loss, it's going to create an expense for you. The problem is that we're probably not expecting that to occur again in the future because it's not part of your normal operations. So we need to put it below our net operating profit. We create a little bucket for that called other income and other expenses. The second bucket under the net operating profit line is our financing costs. These are the expenses associated with any kind of financing that we've taken on as a business owner. A lot of people take out an SBA loan, or they borrow money from friends and family, or they take out some debt from a bank, or they put things on a credit card if they want to go full tilt early on. One thing that's really interesting to note about financing costs on your income statement is that we're actually only going to put your interest expense on your income statement. Let me break that out for a second. If you're a homeowner, the same thing applies. When you get a mortgage, your mortgage company is actually going to show the principal payment and then the interest payment associated with it. If you own a home, the interest that you pay on the principal is the part that you actually get to deduct from your taxes as if it were part of a business expense. Same thing applies with businesses. You don't get to write off the principal that you pay down, but you do get to write off as an expense the interest associated with that principal. The third bucket is depreciation. Let's talk about that for a second. Depreciation is the idea that you're going to buy something that's going to have a useful life that's longer than the period that the income statement is covering. So for example, let's say you buy a computer for $2,000. You're probably not going to throw it away at the end of the year. You're probably going to use it for 4 or 5 years. Let's say you buy a computer for $2,000 and you use it for 5 years. It makes more sense to break that expense up over the course of those 5 years, so $400 a year. Okay, so that's a lot of stuff to throw at you. But after you take out your direct expenses associated with your sales, your operating expenses or overhead, we're left with net operating profit. Then we're going to subtract out any kind of non-normal expenses and income, and then we're going to take out any kind of interest expense, any kind of depreciation expense, and that's going to get us to our bottom line. Now, our bottom line is often referred to as net income, but it's more appropriate to refer to it as pre-tax net income because you still have to pay taxes on it. Now, what does all this have to do with efficiency? For each one of these sections of the income statement, sales, direct costs, operating expenses, non-normal expenses and income, interest expense, and depreciation, you're going to have a number in there called the margin. The margin is where you take that number and you divide it into your total sales, and that gets you a percent. That percent or margin can be compared to other similar businesses like yourself. For example, if your direct expenses are usually around 50% of revenue, but you have a competitor whose direct expenses are more like 40% of revenue, the first question we would want to ask is, why are you paying 10% more of your revenue to service your goods or services? This is the concept of benchmarking, and this is where a lot of the strategy comes into play from a finance perspective for how to make a business more efficient. At the end of the day, we're trying to figure out how many cents of every dollar that you bring in ends up at your bottom line. Now that we've covered the high level of what an income statement is about, what you're supposed to get from it as a business owner, and the general structure of it, let's go to part 2. Part 2 of an income statement is going to cover where is your income statement and how to access it. Thanks for watching.